investors can start investing on the same day, invest the same amount every month, stay invested for 15 years, and yet can have very different journeys. Not because one picked better stocks or invested more money, but because they chose two different investment structure. One chose a Flexicap fund, other chose a multi-cap fund. Now let me clarify that this video is not about proving that one category is better than other. Both categories have their own strength and both have created wealth over a long period. The purpose of this video is to help you understand the difference in investment philosophy behind Flexicap and multi-cap fund, so that you can decide which one aligns better with your own investment style. By the end of this video, you will have a much better clarity to decide which category aligns better with your own investment style. Alright, let's get started. Let's first understand one important concept. Indian stock market is broadly divided into three categories based on the size of companies: large cap, mid cap, and small cap. Large cap companies are India's biggest and most established businesses, and they generally offer relatively greater stability. Mid cap companies are often in growth phase of their journey that offer a balance between growth potential and risk. Small cap companies, on the other hand, can create significant wealth over long term, but they also tend to be more volatile and carry higher uncertainty. Think of these as three different engines of stock market. At different point in time, different engines take the lead. Sometimes large cap outperform, sometimes mid cap, and sometimes small cap. The challenge is that no one can consistently predict which market cap segment will lead next. That's why the real objective is not choosing the best market cap. It's about having the right exposure to all three market cap based on your investment philosophy. And that brings us to key question. Who should decide this allocation? Should it be the fund manager, or should the investment structure itself ensure that your portfolio remains diversified across all three segments? That is exactly where the difference between multi-cap fund and flexi-cap fund begin. Let's discuss it. At first glance, multi-cap and flexi-cap look very similar. After all, both categories can invest in large cap, mid cap, and small cap companies. But the real difference is not where they invest. It's how much they invest in each segment, and more importantly, who decides that allocation. Let's start with Flexicap fund. As the name suggests, they offer flexibility. SEBI requires a Flexicap fund to invest at least 65% of its corpus in equities. But beyond that, fund manager is free to decide how much exposure should go to large cap, mid cap, or small cap companies. There's no minimum allocation prescribed for any of the three market cap segments. However, if you look at top Flexicap funds today, you will notice that a significant portion of their portfolio is invested in large cap companies. One reason is that large caps form the biggest part of India's listed market and are generally considered relatively more stable and liquid. So depending on investment philosophy and market outlook, many fund managers choose to keep a bigger allocation towards large cap. But remember, this is a fund manager's decision, not a regulatory requirement. Multi-cap funds, on the other hand, follow a very different framework. Here, SEBI has laid down a clear structure. A multi-cap fund must invest at least 25% each in large cap, mid cap, and small cap companies. That means a minimum of 75% of portfolio is always spread across all three market cap segments, while remaining 25% gives the fund manager flexibility to allocate where they see the best opportunities. And this is the biggest distinction between these two categories. In Flexicap fund, market cap allocation depends largely on fund manager's judgment. In multi-cap fund, the allocation framework is already defined by the category itself. So neither approach is right or wrong. The real question is simple. Do you prefer to leave market cap allocation largely to the fund manager, or do you prefer a structure that ensures participation across all three segments throughout your investment journey? Now you might be wondering, why does this structure actually matter? After all, if a good fund manager can decide the allocation, why should an investor care whether it is predefined or not? The answer lies in one simple fact. Market leadership keeps changing. There are periods when large cap companies outperform because investors prefer stability. Then there are phases when mid cap companies take the lead as economic growth picks up. And there are also times when small cap companies become the biggest wealth creators. The challenge is that these leadership changes are extremely difficult to predict consistently. This is where multi-cap structure stands out. Since the fund is required to maintain exposure across large, mid and small cap companies, your portfolio continue to participate across all three segments, irrespective of which one is currently in favor. You don't have to predict when leadership will shift, and you don't have to worry about missing an entire segment of market. This becomes even more relevant if you are investing through SIPs. Most investors don't review their portfolio every month and decide whether to increase large cap exposure, reduce mid cap allocation, or add more small cap. Nobody do that. In reality, the biggest strength of SIP investing is consistency. You invest regularly and let compounding work out over time. And that's where a multi-cap fund complements this philosophy quite well. Every SIP installment automatically gets exposure across large, mid, and small cap companies because the diversification is built into the category itself. You don't need to keep switching between different fund category or worry about whether you are investing in right market cap segment at the right time. It also helps reduce the temptation to chase performance. Many investors move from large cap fund to mid cap fund after the rally is done and then shift to small cap fund once they've already delivered strong return. Unfortunately, this leads to buying high and selling low. A multi-cap fund encourages a more disciplined approach by ensuring your portfolio remains diversified across market cap throughout your investment journey. Now let's look at what data suggests. Now when we look at category level data, an interesting trend emerges. Over the last 3 years, several multi-cap funds have delivered returns that are in many cases higher than Flexicap fund. For example, in this slide, we have shortlisted the returns of most popular multi-cap fund. Axis Multicap Fund has delivered around 18% annualized return over 3 years, followed with Kotak and ICICI Multicap Fund. Whereas if you look at top Flexicap fund return performance, it is relatively lower. SDFC Flexicap is leading the return, followed with Aditya Birla Flexicap and then Parag Parikh Flexicap. But some funds have delivered below 10% return. Now this does not mean multi-cap funds will always outperform Flexicap fund. A 3-year period is relatively short and different market cycles can produce different outcomes. But the data does show that with multi-cap category, investors have been able to participate in the growth of all three market cap segments through a single product. Now the next question is, how do you identify a good multi-cap fund? Let's discuss it. Please note that two funds belonging to same category does not mean they will deliver the same investor experience. The category gives the framework, but how that framework is implemented depends on the fund manager and the investment process. That's why choosing the right fund is just as important as choosing the right category. So what should you actually look for in a good fund? Well, the first thing is portfolio quality. Does the fund own fundamentally strong businesses across market cap, or is it taking excessive risk in pursuit of return? Of course, in this case, you need deeper stock level knowledge. Then second factor is diversification and portfolio construction. Even within multi-cap mandate, different funds can have different levels of concentration and sector exposure. Then third is consistency. Rather than focusing only on 1 year or 2 year return, investors should evaluate how the fund has performed across different market cycles and whether it has remained true to its investment philosophy. Another important aspect is risk-adjusted performance. Two funds may generate similar return, but one may deliver such return with lower volatility as compared to another fund. That's why metrics like Sharpe ratio, beta, standard deviation can provide useful insight. Okay, let's look at Axis Multicap Fund as an example, as it has delivered strong returns in last 3 years. So currently this fund has an NAV of around 1920 and has generated around 15.8% annualized return since inception. AUM is around 10,500 crore and expense ratio is 1.1%. Now here is the asset allocation. Almost entirely invested in equity, and within that around 45% is in large cap, 22% in mid and 28% in small cap. Sector-wise, financial hold the highest allocation, followed with auto, services and then healthcare. One aspect that stands out about Axis Multicap Fund is its focus on quality growth businesses rather than simply chasing cheapest stock or latest market trend. Its portfolio is diversified across large cap, mid cap and small cap companies, but within each segment, it appears to favor businesses with strong competitive position, scalable business model and long-term growth potential. This suggests that the emphasis is not just on maintaining the multi-cap allocation, but also on identifying quality businesses across market cap spectrum that have the potential to compound over the long term. Finally, if you look at the risk ratio, its 3-year returns are much higher than category average. Beta, that is volatility, is also lower than category average. And most important, both Sharpe and Sortino ratio that suggest risk-adjusted return are much better than category average. So overall, Axis Multicap Fund looks good. But again, this is not a recommendation. I have used it as an example to evaluate the fund. Now, after listening to everything we have discussed so far, you might wonder, does it mean every investor should simply choose a multi-cap fund over a flexi-cap fund? The answer is no. Every investment category has its own strength and trade-off. The biggest advantage of a flexi-cap fund is flexibility. Since the fund manager is not bound by a predefined market cap allocation, they can increase exposure to large cap companies during uncertainty or allocate more towards mid cap and small cap companies when they believe better opportunities exist. A multi-cap fund follows a different philosophy. Instead of trying to actively predict which market cap segment is likely to outperform next, it stays invested across large, mid and small cap companies through a clearly defined allocation framework. This means investors get consistent participation across broader equity market. So in my opinion, neither approach is better than other. It ultimately comes down to what you value more as an investor. If you prefer giving the fund manager greater freedom to make allocation decision, a FlexiCap fund may suit your style. But if you prefer a disciplined framework that ensure your portfolio always remain diversified across all three market cap segments, then a multi-cap fund can be a good choice. In other words, it is not a debate about which category is superior. It's about choosing the investment philosophy that best aligns with your own long-term approach to investing. So this is it for the video. I hope you'll find it useful. If you have any doubt, let me know in the comments. I'll see you next video. Till then, take care.